Eurozone bond yields dip as PMIs indicate sluggish growth. Welcome to Market Insight, I'm Ramzan Karmali. Well, October's data showed that in general business activity across Europe was in contraction. The latest evidence pointing to a weakening economy seems to have seen the market pivot towards a 50 basis point cut from the ECB in December. But are traders right to do so? Well, to help answer that and more, I'm joined by Vicky Pryce, Chief Economic Advisor at the Centre for Economics and Business Research. Vicky, thanks so much for joining us. Well, let's start with the PMIs. The euro area is still shrinking, but the pace of decline has slowed. Why do you think that is?
There has been a little bit of improvement, particularly in the services side. So that's basically what's been going on. Manufacturing has been a bit in the doldrums and continues to do so. And even in services, we've seen some different trends in different countries. So we have to watch it. I mean, look at France in particular, which is suffering right now, where business confidence seems to be really going down very significantly. So what we've got is an economy which is more or less stagnant across the Eurozone. There are some differences in different countries, as I said, but overall, I think what we're seeing is that some of the improvements, again, I mentioned France, that we saw in the summer because of the Olympics, seem to have come to an end. Germany has a traditional problem which doesn't seem to have gone away of looking at other contraction or very little growth in the year as a whole. So what is happening is that the central bankers are beginning to worry, are we perhaps about to see both deflationary trends sort of becoming more intensified? And we've seen that already happening in terms of input costs really falling, which is good news in some areas, but not so good in terms of what it may suggest for the future. And are we also perhaps at the same time seeing growth really slowing down to such an extent that we need to start focusing on that? And hence why everyone is now beginning to talk about quite a substantial cut in interest rates next time round.
So, Vicky, the markets, though, they're pricing in a 43% chance of a 50 basis point rate cut by the ECB in December. Do you think that's the right policy?
It's going to have to happen, I think. We've seen, of course, the European Central Bank cut rates faster than others. I mean, we had finally, of course, a move from the US with a 50 basis points cut a little while ago, but there's an expectation that we may well see another 25 point cut. Could actually be 50, depends on what the data tells us in the next few days. We're getting some more data coming out of the US, so they'll decide on that. But overall, I think the markets are getting ready for a trend now, the cycle of cutting rates being accelerated, because without that, I think world economic growth is going to be an issue, and not just for individual countries, but more generally. And we've seen the IMF also sound quite pessimistic, particularly by the advanced economies. So we are getting to the point where the questions are, did we overdo the monetary tightening? And do we actually need to loosen up? That isn't just interest rates, but it's also is the quantitative tightening that is going on right now, perhaps a little bit too exaggerated too. So I think there is a look again. The focus is beginning to be on growth because inflation looks like it's been tamed. Yes, there are some question marks. The Middle East, for example, what may happen to oil prices, which, at times show signs of picking up again, but not that much. But overall, there are some concerns like that. But the general expectation is that inflation is going to be at or below target or around target from now on for some time to come. And therefore, you can take the risk of cutting rates because otherwise growth will suffer.
Now, the commentary from policymakers at the ECB seems very split. So who do you think is going to win the argument, the doves or the hawks?
I think the doves. We're getting, as you rightly say, different views, not just, of course, in Europe, but also in the UK. Every time a different policymaker speaks, you wonder what the impact on the markets will be. But also, of course, in the US. And it's interesting when you look at some of the trends in stock markets just recently. So, like, for example, yesterday, stocks fell very significantly because there was a concern that perhaps interest rates were not going to be cut that much. That then changed a little bit today. So what they say, what policymakers say, matters hugely, as we know. But where the balance will be, I think the overall belief now is that it will be the doves that will win, because indeed growth is becoming more important a consideration than anything else.
Now, looking ahead to Friday, we get German IFO data. Are we expecting more bad news?
Yes, I would guess so. So if you look at growth, actually, which is forecast for next year, this is a surprising thing. I think for this coming quarter, it's not going to look particularly good, or this quarter we're in actually now for Germany. But there are some quite optimistic forecasts out there. So the IMF, for example, is anticipating that we may get 1.3% growth in Germany in 2023. Now, of course, if you start from a very low base, perhaps, but I think this IFO data which is going to come out is going to be quite crucial to tell us where we may be going ahead. And if you look at some of the PMIs, yes, there's been a little bit of an improvement in some of them, but still overall we're talking about contraction in Germany for the foreseeable future. And that is a real issue. How can it turn around? With difficulty, unless interest rates get cut quite significantly.
Vicky Pryce from the CEBR, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.